Guys, if you think money market is the same as capital market, you are very wrong. Welcome to Monday Money Moves. I'm Michael Abayomi, also known as Spring Boss. And of course, I'm the Group Managing Director and CEO, Asset and Equity Group. Asset and Equity Group is a foremost investment banking group in the heart of Lagos Island and Victoria Island, Nigeria. And of course, we have some offices in major cities of the world. Today, we will be navigating the financial markets with emphasis on two of the most influential components of the market, that is, the money and the capital market, and exactly how you can capitalize on the system to make huge returns from your investment, as well as raise capital for your business. So now, what is money market? The term money market refers to any market where money and several other types of liquid assets such as treasury bills, commercial papers, bankers' acceptance, bank deposits, bills of exchange, repurchase agreements, and maybe some asset-backed securities, etc., are lent and borrowed for a period of 1 year or less. In simple and concise terms, it is a market constituted by banks, retail investors, fund managers, hedge funds, broker-dealers, and say non-financial corporations, which allows participants to make short-term investments, as well as give banks and other financial institutions some kind of investment, as well as allowing non-financial institutions reasonable access to funds at low cost. Now, what is capital market? A capital market is a financial market in which long-term debt or equity-backed securities such as bonds, stocks, derivatives, etc., are bought and sold, in contrast to a money market where short-term debts are bought and sold. Now look at it this way. The capital market is that market where a large chunk of that your savings that you put in the bank are moved to people who need it as capital to build real businesses to make good returns. Players in this space include stock exchange, the commercial bankers, investment bankers, private equity firms, central banks as a regulator, all kinds of institutions that are self-regulatory and all of that. So, judging from the above descriptions and definitions, you may be wondering exactly how you can possibly raise capital or invest, in the midst of all these complexities that are painted, and that's understandable. But it is important for you to note that the capital market is not a new market. It has been serving individuals and institutional investors and borrowers alike for well over 400 years. However, proud to them, there were also evidences of capital market activities during the ancient Roman Empire, so it has always been around. Some of the most popular capital market activities in history were those of the two major companies by the name Dutch East India Company and the Dutch West India Company, both in Amsterdam, both founded in 1602 and 1621 respectively. This went down in the form of corporate bonds, most likely. The history of the Nigerian capital market dates back to the colonial era, precisely 1946, before the central bank was established in 1958. I bet you didn't know that. The issuance of the first development stock of £300,000 sterling by the colonial administration may be the first, and this means that this may actually be the very first government borrowing in all of Nigeria's money and capital market history. Apparently, this is most likely some kind of bonds to finance some government project at the time. But all the same, it is definitely an avenue for some people to make investment through lending to government, since government bond is definitely government's way of borrowing from the public. So what am I saying in all of this? Exactly what I'm saying is that you too can invest or even raise money through the capital market as well as the money market for that business of yours via deposits, debt, equity, securities such as bonds, stocks, commercial papers, etc., etc. And there are several ways to go about this. Number one, you can decide to list your company on the stock exchange through an IPO, that is, an initial public offer. A very good example of this is the Nigerian Stock Exchange. And if you like, the New York Stock Exchange, the London Stock Exchange is also there. This will open your business to the world of individual and institutional investments, where you don't have to lobby or persuade people to invest in your business. It is purely performance-based. Number two, you can invest in or issue bonds or commercial papers to earn returns or raise capital from individual and institutional investors. Both are debt instruments, unlike stocks, which are purely equity securities. Take note that commercial paper is a discounted and an unsecured form of promissory note that pays a fixed rate of interest. Promissory note in the sense that this means that you as a borrowing party, you promise to pay back whenever the lender or the investor calls. Most banks and corporations use commercial papers to cover short-term receivables and meet short-term financial obligations, which could be, either to fund a new project or to stabilize working capital, or maybe any other acceptable obligations, within regulatory procedures. It is not exactly the right instrument for long-term borrowing. Having said that, this process starts with you finding a brilliant investment banking firm like Asset and Equity Group to help you with crunching your numbers as well as helping your institutionalization process to strategically position you for investors and regulatory acceptance. We already know who the investors are in this case, but who exactly are the regulators? These are institutions authorized by law or legislations to protect industries from external threats or maybe self-destruction in a way. There are a handful of regulators in the financial industry. However, in this case, the lead regulator is the Securities and Exchange Commission under the supervision of the Federal Ministry of Finance, with other regulators such as the Nigerian Stock Exchange, the FMDQ, the National Association of Securities Dealers, that's the NASD, and other self-regulatory platforms that exist within the Nigerian context. So guys, it will do you and your business much good to approach Asset and Equity Group today to discuss the core financial needs of that your business vis-a-vis your organization strategy. It will be our utmost pleasure to help you invest rightly or even raise capital from the capital and the money market to support your business. Meanwhile, to have a balanced discussion, it is very necessary that we also talk about investment into the capital market, because like every normal market, the capital and the money market has both the demand and the supply side. And while the borrowers constitute the demand side of the market, the lenders, otherwise called the investors, are firmly on the supply side and they definitely deserve the best return on their investment. It is a fact that investors always get better returns from investment banking institutions than regular banks, or let's say the commercial banks. And this is simply because investment bankers practice what I call the asset pooling and slicing mechanism, meaning that they are able to pool funds from different investors to approach institutions like commercial banks or other ones that, request for funds or borrow, and negotiate better returns on deposits or other types of asset classes. For example, if you approach a commercial banking institution with 100 million naira today, they will offer you around 5% return. An investment banking firm will get 49 other people like yourself with 100 million naira each. That will make 5 billion naira. And then they will approach the same bank to get about 15% return on that 5 billion naira. Every member of that pool will now have additional 10% return. You see how that goes? That is why investment bankers are called investment bankers. So guys, this is one of the many investment banking gigs. And that will be all for today's episode of your favorite finance plug, the Monday Money Moves. I'm Michael Abayomi, also known as Spring Boss, and of course, the Group Managing Director, Asset and Equity Group. Please stay tuned for the top news section. Thank you. So guys, welcome to the top news section of the Monday Money Moves. Mark Zuckerberg now worth 132 billion as a result of Facebook's market cap that hit $1 trillion, very recently, a few days ago. Exactly 18th of May 2012. It was really a great day on NASDAQ. It accounted for the biggest IPO in technology history, and say one of the biggest in internet history as well, with over $104 billion in market capitalization. Facebook. And if you are wondering exactly what is market capitalization, market capitalization simply means the value of a company's stock, that is the price of the stock vis-a-vis the number of outstanding stock it has. So basically, Facebook launched and was valued on that same day at 104 billion. This is what the capital market can do for you. Anyways, that will be a topic for another day. So this is Facebook capitalizing on the dynamics of the capital market to spring up from being an ordinary startup to becoming a unicorn, and maybe now that it's already on $1 trillion, maybe it can be referred to as a trillicorn, if there's any word like that. So in addition to that, the capital market exposed Facebook to funds, and which Facebook has equally capitalized on to, make all those acquisitions that it did, about 92 different businesses that Facebook acquired, issuing bonds and all kinds. Companies like Instagram, Facebook, Face.com, Oculus, virtual realities, and all of that. This might not have been possible without the market, or better still, without the capital or the money market operations that lifted it. And that will be all for the top news of this week. Now, the next session will be the quote of the week. So guys, the quote for this week will be, there are no competitors in the financial market. You are either a lender or a borrower. What do I mean by this? In the world of financial markets, there are only two people involved. You go to the market to make investment. That investment you make is going to be gathered, because it's an intermediation procedure. The banks are there as intermediaries between you and people who need your money. So as an investor, you approach the bank and you put in your funds, bearing in mind that as you are approaching the bank and offering that fund or giving that deposit, there are so many other people approaching the bank to take loans, like to take that same money in the form of loans, in the form of advances, overdrafts, in the form of all kinds of debt instruments. Now, looking at that from that, judging from that angle, you already know that if your money goes from your pocket to a particular venture that will pay back with returns or with interest, you are directly or indirectly an investor into that person's business. So whoever goes into the bank to take a loan is termed as the borrower. So in this whole game of the financial market, there are no competition. You deal per time as your situation warrants. Today you may borrow from the bank, tomorrow you may deposit in the bank. Today you may come to the capital market, to the stock exchange, and IPO your firm or issue shares and people subscribe to it. Tomorrow you may also come to the same capital market and buy other companies' shares. So directly or indirectly, we are all in the business of helping each other out as occasion demands. And that will be all for this quote of the week session. We meet right back next week. Thank you. So guys, that will be all for this week's episode of the Monday Money Moves. Next week, same station, same channel, same social media handles here and there. We'll meet again and we'll keep learning to improve our financial decision making. Thank you very much.